In the current crisis, what exactly has broken? How do we respond to systematic crisis if there is no playbook? What is the best role for the government to play in time of crisis? Is there a better way to deal with the asset bubbles going forward? Is there a need for a sustained revamp of industrial governance? What are the options for dealing with systematic crisis? What are the necessary change? Scholars, politicians, and practitioners from across the world address these and related problems with an emphasis on the consequence for public policies. So now we will go deeper and find out what is going on with the international financial crisis. Microeconomic imbalance produced MIP is a monitoring method that seeks to find any existing macroeconomic imbalance, address them, and identify any potential new ones. It therefore acts as a system of monitoring economic policies and warning decision maker of potential dangers to the economics of particular EU member states, the EMU, and the EU as a whole to monitor any emerging imbalance or declines in competitive that could be harmful. A scoreboard has been set up. It makes use of stock and flow indicators, which may be used to measure both to account for both short-term and long-term imbalance. Should we accept that if cultural problems are to blame for macroeconomic imbalance, they won't be resolved in the foreseeable future? Not at all. While capital transfer occur on a variety of scale, including everyone from individual to organization to governments, various subgroups of capital flows such as assets class movements, venture capital flows, mutual funds flows, capital spending, budgets, and the government budget are frequently the focus of analysis attention. Organizations at the federal and states level around the United States gather information on capital transfer for use in research, regulation, and legislative projects. A type of asset class mobility measured in terms of movement of capital between different asset classes on the financial market is investment in a startup business. Fund flows chart the cumulative net cash inflows and outflows from numerous different fund classes. To maintain track of capital expenditure, businesses analyze their budgets.
And now I will explain about capital control. To prevent capital movement in the financial account, capital control may be imposed. Inflow restrictions are more effective than outflow restriction. It is to reduce the inflow of short-term capital, which would increase the stock of liquid, potentially volatile capital. When a crisis occurs, outflow restriction may help to mitigate its impact, like Malaysia weathered the Asian crisis through outflow restriction. And next is about managing crisis, domestic policies. Microeconomic policies crisis can be averted by, first, allowing the currencies to float, increasing interest rate, and reducing the deficit. Unexpected capital flight crises are more difficult to treat. Collapsing currency can be defended through interest rate hikes, but this may cause bankruptcies and other problems. And the last one is managing crisis in sum. Crisis management is politically because it creates losers in the domestic economy. If the crisis has an international component, fiscal and monetary policies are contrasted. It is defending currency with high interest rate, but spreads the crisis recessionary effect. Last one is defending the economy against recessionary effect, but exacerbates the problem associated with a collapsing currency.
Reform of the international financial architecture. Reform of the international financial architecture is a new international policies for avoiding and managing financial crisis. The great variety of reform proposals focus on two issues. First is the role of an international lender of last resort, and second is the conditionality. Lender of last resort is a source of loanable funds after all commercial sources of lending become unavailable. The central bank in the national economy. The IMF with support of high-income country in the international economy. A country unable to make a payment on its international loans or lacking international reserve asks the IMF to intervene. Opponent of international lender of last resort cite moral hazard problem. Trusting in a bailout, failing firms have an incentive to gamble on high-stake and high-risk venture. The proponents is moral hazard can be decreased by financial sector regulations, such as the Basel Capital Accord. If owners of financial firms risk losses in the event of a meltdown, they will not engage in excessive risk. Debate on the IMF roles as a lender of last resort and moral hazard centers on level on IMF interest rates should be raised the higher, length of the payback period should the period be shorter, size of loans, countries often exceed the borrowing limitation of 300% above their quota, should be borrowing limits be curbed. Conditionality is the changes in economic policy that borrowing nations are required to make in order to receive loans from the lender of last resort. typically covers monetary and fiscal policies, exchange rate policies, and structural policies affecting the financial sector, international trade, and public enterprises. The IMF makes loans in tranches. Tranches is an installment of the total loan. Each tranche hinges on the completion of reform targets. Crisis of conditional argue the need to comply with conditionalities may intensify the recessionary effects on a crisis. Conditionality may entail high social costs on the poorest member of the society. Proponents argue that crisis could be avoided by a pre-qualification criteria. To receive assistance, countries must meet requirement of sound financial sector policies. However, crisis claim that pre-qualification will not deter speculative attacks on the country currency, and the IMF could not ignore crisis cases that fail to pre-qualify.
Next is escaping moral hazard. The moral hazard is inescapable if policies to protect the financial sector exist. Next is there are several ways to reduce moral hazard, including incentive, policies to prevent immoral behavior, and regular monitoring. And the next is establishing norm for oversight and regulation of globally operating banks is one way to lessen the issues. Basel Capital Accord. More than 100 countries have ratified the Basel Capital Accord, which was developed in 1989 by bank regulators from industrialized nations. The 2001 New Basel Capital Accord revised from earlier norms. Next is New Basel Capital Accord. The New Basel Capital Accord will be applied on a consolidated basis to internationally active banks. This is the best means to preserve the integrity of capital in banks with subsidiaries by eliminating double gearing. Recommends 3 best practices to reduce the problem of moral hazard. The first one is capital requirement. Bank owner must invest a percentage of their own capital. Next is supervisory review, a risk management and business practices supervision mechanism. And the last one is information disclosure. Bank must give operating details to lender, investor, and depositors. Next, avoiding crisis exchange rate policy. First is crawling peg increases vulnerability to financial crisis in 3 ways. The first way is require monetary authorities to exercise restraint in issuing new currency. Next is intentional slow devaluation can exacerbate anti-inflationary tendencies and lead to a significant overvaluation of the real exchange rate. And the last one is existing crawling peg is challenging because the government may lose the trust of investors. Last point is hard peg of variable rate according to the current opinion.
Emerging issues in international financial architecture. Need for greater transparency to make a country's financial standing clearer to potential lenders. First is Basel Capital Accord includes issues of transparency and data reporting. And second, data dissemination standards. The IMF's standards for data reporting is currently under development. Next is emerging issues in international financial architecture 2. Need to coordinate private sector involvement. Private sector creditors' insistence they be paid first make it more difficult to resolve a crisis. How to resolve the conflict between lenders? The first is standstills. IMF recognition that a crisis country temporarily stop making repayments on its debt. Second, collective action clauses. Lenders would have to agree on collective mediation among themselves and the debtor in the event of a crisis.